Bloomberg Audio Studios.
Podcasts, radio, news.
We begin this hour with stocks at all-time highs ahead of CPI, the next key data point for the Fed after September's blowout jobs report. Mike Wilson of Morgan Stanley updating his outlook, writing Friday's strong jobs data and our economists' call for a series of 25 basis point rate cuts from here lead us to upgrade cyclicals to overweight relative to defensive. Mike joins us now for more. Mike, good morning.
Good morning. How are you, John?
I'm good. It's good to see you. Let's talk about that overweight to cyclicals. Walk me through what's behind that and what kind of names you want to be behind at the moment.
Yeah, it's a very nuanced call, so I want to be crystal clear about what we like within cyclicals. Look, we're still not that convinced that there's going to be some big robust recovery. That's when you really want to buy the early cycle kind of cyclicals, and we're not in that camp. We're still in the late cycle momentum here. But remember, this market has gone back and forth as the economic data has come in differently this year. Beginning of the year was a no landing scenario. Then we kind of reverted back to this sort of soft landing and then even a hard landing risk this summer. And now we're kind of back moving towards the no landing. So we're just trying to trade this back and forth, and we've been actually trading the rotations quite well this year, and so we're just taking we've had a great call on the defensives. We took that off 3 weeks ago. We neutralized that, and now we're just saying, look, you can step in a little bit more to the late cycle cyclicals. So that's quality names, right? It's not buying the early cycle junky, bad balance sheet type names. This is materials. This is industrials. Okay, this is some of the quality maybe software names to some degree because they're pro-cyclical. It's not a wholesale go down and buy the junk. That's what we want to make clear here.
I've been through enough cycles with you now to remember that also you mentioned, I remember a long time ago, late cycle energy. You didn't mention energy this time. Why not?
Well, I didn't mention it, but we are overweight energy.
Okay.
Now, that's been more of a hedge for us on the geopolitical risk. And we, to be honest, we had a bad call on energy. We kind of upgraded it in March. It worked really well until April. It's, hasn't done well since then. But now it's having a little bit of a comeback. So for us, we like materials and industrials more than energy. But energy is a good hedge against what's going on in the Middle East. And just, the fact that maybe things do accelerate and maybe we do get better demand in the energy side. It is cheap, right? And that's the other reason we upgraded financials this past week, is because as rates go back up at the back end, financials tend to do a little bit better.
Okay, that's where I wanted to go.
Yeah.
This question of the relationship between bonds and stocks, because we saw for a while there was a feeling that if yields went higher, that would be punitive for equity valuations. And then recently, that hasn't been the case. Mm-hmm. Has that been surprising to you?
Well, no, think about this, right? So the Mag 7 or, some of the expensive growth names since July have really underperformed. In fact, that group has not made a new high. So the market is sort of punishing the more expensive stocks for the higher rates. And that's part of our call too, is that part of this rotation back towards, say, quality cyclicals or some of the other names that haven't worked so well this year is just money leaving the big winners as rates back up. So as we wrote in the note last week, the biggest confirmation to me that this data last week was somewhat real is that 2-year yields in particular really ripped, okay? And 10-year yields ripped at the same time. That's the bond market finally saying, hey, maybe there is something to this soft landing and maybe things can actually hold in here, because the bond market's been very skeptical really up until last week, and that's a big deal.
So if I'm hearing what you're saying and taking it a step further, is it correct to say that the big tech companies, based on their valuations, are actually more highly levered to rates being somewhat lower, and that the cyclical companies are less sort of tied to that in terms of valuation? In other words, they don't need money to be cheap forever for them to maintain their valuation. Is that basically what you're looking at?
Yeah, and once again, we did neutralize our small cap versus large cap call this year. We don't want you buying small caps wholesale. Same thing, quality stocks do better, and not the low quality stuff. Because let's not forget, low quality, bad balance sheet, small cap companies are not going to do well until rates really come down. All we're saying on the big cap tech stocks is there's two things going on. Number one, they got a little expensive. They're probably overowned. But also the fundamentals are deteriorating a bit, right? Last quarter, the market wasn't that excited about some of the spending the hyperscalers were doing without showing the returns they're getting on the revenue side. So that group to me looks like it's just taking a break. It's not that it's going to crash here and rates are going to ruin the whole story. It's just they got overcooked. And we wrote about that 2 months ago. And since then, that's exactly what's happening. But that's the fuel for some of these other underperforming areas to work. Even China, quite frankly. Part of the reason why China ripped so much, was because there's so much money looking for a new theme. And it was like, oh my goodness, here's a new shiny toy, jumped in there, popped up, and now we're selling off again. And that's actually been our view too, is that we're not buyers of the big China stimulus. However, it can cause 20 or 30% moves because the market is desperate for a new theme.
Well, the new theme of the year so far, before October 2nd, Well, utilities absolutely ripped. They topped October 2nd, 2 days before we got the payrolls report. As you pointed out, yields ripped, utilities have suffered. I want to talk about how timely that removal of that defensive overweight actually was with regards to that. Yeah. Were utilities a part of that call for you?
Well, it was. We basically, the whole defensive sector, we just said, look, you can fade it here. We definitely want you adding more risk within defensives. Utilities is definitely part of that. Now, utilities is interesting this year because it's a defensive play because of, it's always defensive, but it also has this power story. And so we kept that one as an overweight, but we're not adding to it here because of that secular growth sort of story. Now, it did sell off more than other defensives earlier this week because I think it's crowded. We showed in our 100th percentile of ownership within our institutional base of clients. So it's crowded. I think it can hang in here. The one thing about utilities that people don't appreciate is if we go back into a kind of hard landing scenario, I'm not predicting that right now, but if that were to happen, utilities tend to do poorly, because their balance sheets are actually not particularly good. So it's going to be interesting to see if it can hold up into that. It should do better, though, in the no landing or kind of re-acceleration story.
Where do financials fit in? Why the upgrade going into earnings season?
It's similar to our call on the group, the quality cyclicals. So we are very distinct about this too. We don't want to own the low quality financials. We want to own companies that have the ability to see NIM expansion, can monetize that, or have capital markets activity. So those are generally your larger cap financials, your higher quality financials. And I think that's sort of been showing its hand. The other thing you have to keep in mind is earlier in September there was an industry conference for the financials, and they did lower the bar quite a bit. So the expectations in that group going into this earnings season, I think, look particularly good.
You talked about the shiny new toy. I want to talk about the shiny new toy and the sort of rolling ball of cash that just is looking for a new theme. When will that rolling ball of cash not be a rolling ball of cash? When will we not feel like there's this glut of money looking to go somewhere? Why is that such a prevalent theme in all of market action so far this year?
I think it's just a classic late cycle phenomena, right? I mean, things are expensive, right? I mean, the Fed is cutting, but they're cutting because growth is now the worry. And that's what stocks need growth. We need, for a big sort of broad rally in the small caps, lower quality areas, we need either rates to come down in a more meaningful way to kind of jumpstart that recovery, or we need, a reacceleration from a new source of growth, and we don't have that right now. So instead of having that rising tide, what the market's doing is looking for individual themes. Last year was GLPs, it was AI, of course. Now maybe it's China. There's some industrialization theme that's been pretty exciting. We've been on that top of that one, but these are temporary, right? And the market is fickle. It will basically throw the shiny new toy into the dustbin as soon as it doesn't perform anymore, and we see that too. So you just have to be very, willing to be flexible. And we've adjusted our, forecast this year for that same reason. You have to be flexible. You have to adjust what the market's giving you.
How flexible do you need to be after the election? I'm thinking of corporate tax rates. That's going to be a huge debate, as well as tariffs. Yeah,
so tariffs is the one that's easier because it doesn't need congressional support. I think the baseline view from most clients we speak to in our house view is that probably the most consensus thing is that we're going to have gridlock in Congress, right? It's going to be hard for one party to get a full sweep. So if that happens, then taxes is kind of off the table, for higher taxes. You could maybe see an extension of the tax cuts from 2017, so that's possible with congressional gridlock. The tariffs, though, can be enacted at the presidential level. So obviously in the Trump scenario, that's probably a worse scenario than it is with Harris. But I do think both administrations have shown their hand on that. I don't think tariffs are going away if Harris gets elected. I mean, I think the penchant there will be to kind of continue what the Biden-Harris regime has done for the last 4 years.
Do you buy into this narrative that maybe Kamala Harris is good for the bond market the way Donald Trump might be good for the stock market?
That's the way we've been talking about it for the last several months, is that Trump is probably not as favorable for the bond market because he's more of an inflationist, and the tariffs, of course, are part of that story, but also he wants to cut taxes. But the stock market may like that more. Okay, and if you get a blue sweep, that's probably the worst case scenario for stocks, because then the risk of tax becomes legitimate.
How difficult is it to come up with an index level call for 12 months' time?
Well, it's always difficult. I mean, but I would say we've said this for a long time. I mean, this is the most difficult part of the cycle if you're true to your work. I mean, late cycles are always like we were just talking about. The market starts to rotate around because the opportunity set is less when you get into the later part of an economic expansion. So, 12 months is difficult. I would say the easiest time frame is 7 years. And we've talked about this before too, right? I mean, the only thing that you have over 7 years is valuation. And that's what we keep harping on. Valuations are expensive, okay? I don't care how you shake it. I'm not in this camp that, it's different this time. So if you're investing right now, you have to be with the mindset that you're probably not buying and holding for 7 years at these prices, right? You're going to have to be moving it around across sectors, across individual themes. And we've also been very focused on stock picking. There's always stocks that work. And that's why I think, now the focus, CPI, I'm not that focused on the CPI today, to be true.
I don't think we asked you about it, to be honest.
Because I just think that's yesterday's news in many ways. And unless it's a 0.4 or higher, I think it's going to be a non-event for the most part. What's focused now for the market is going to be earnings season, right? And so idiosyncratic opportunities for clients, that's how they've been focused, institutional clients, that's where they've been focused, that's where they should be focused. And it's a great stock picking market right now.
Can you share a single name? And if you can't, can you describe it?
Well, I would say the way I would describe it is that the factors that are really continuing to work are quality and earnings revision breadth, or earnings revisions, to the upside. So 3-month earnings revisions, and that's how we're positioned. That's the quality cyclical trade. That's where the earnings revisions are now in the better mode. I would say some of the growth stocks, the big large cap growth stocks, their revision factors are starting to fade, right? Because they just got too extended. So that's the key. You got to focus on good is good, right? Bad is bad, and that's the main thing. There's no more of this bad is good. I think that party is over.
We're happy to leave that party behind. Mike, It's good to see you. Thank you, sir. Michael Wilson there of Morgan Stanley.